Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Happy New Year to everyone. Today's guest is a first-time guest. You probably know him if you pay attention to Zero Hedge or RT's famous capital count show or Boom and Bust, RT's new show. And he's also been on Chris Martinson's website for a long time. And he writes a very long and in-depth, each year, once a year, review of the previous year, and then a preview of the next year. And he is Dave Collum, who is a professor of chemistry at Cornell. So thank you for joining us here today, Dave.
Hey, thrilled to be here. We've been talking about this for a while. I'm glad to finally connect up.
Great. Now, Dave, before we start talking about 2013 and then 2014, you're a scientist, so I want to ask a real scientific question about Keynesian economics. Do you think Keynesian economics is a real science, or do you think it lacks the rigorous studies and fact-finding stuff that real science does?
And I think a lot of the economics lacks rigor. I think you can do some stuff that's pretty rigorous, but this big picture stuff, the real macro stuff, the long-term stuff, I'm not sure you can model it, and so I wouldn't call it scientific. I have this definition of economics, which is rather simplistic. And the thing is, the question I ask is, okay, we've been here before. What happened next, right? To me, that kind of captures the spirit of what economics should be. So I view at some level economics as a historical study, and I think you want to see what the folks in the past did and what kind of foolish moves they made, and see if you can not do them this time.
Yeah, and I think the numbers crunchers, the neo-Keynesians and the Keynesians in power right now, they just completely ignore what you said. I mean, they keep saying, our models were wrong. If only we could have better models, blah, 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 blah. And, there's just so many assumptions that go into the human error stuff, and real science doesn't really make those false assumptions that the Keynesians always seem to be making.
Yeah, well, so I've pondered this. If I was given... when we occasionally have a visitor come to Cornell and I go see the seminar, and I think about what question I would ask them. Dudley came through, and Hank Paulson came through, and I thought, give me the microphone, what would I ask them? And I realized that these guys can sort of slither off any hook that I could possibly throw at them. But one of the questions I like
they're good politicians, yeah.
Yeah, well, I mean, they'll give me some stock answer. The problem is that I don't get to retort, so it'll be a single question, single answer, and unless I can engage them, then it wouldn't do any good. So I tend to not ask those questions, although once in a while I'll get into it. The problem I have, so the question I would ask Bernanke, for example, if given a chance, is what would tell you that your models are wrong, right? What would be the red flag that says we simply have it wrong? And I'd love to hear what he has to say about that, because right now they just say, well, it's not wrong, it's just we haven't done enough, right? And that I'd like to know what would cause him to declare a flaw, short of catastrophic demise of the economy, which I don't find an acceptable answer. So,
yeah, unfortunately, Dave, I think we're going through a real life, really bad science experiment right now, where the Keynesians, this is unprecedented. The world has never been on all global fiat currencies before, and here they are, playing mad science experiments. You have them doing global coordinated QE, you have backdoor bailouts to Europe, you have all these crazy things, and you touched on these in your review starting about 2013.
Yeah, and this is trite. A lot of people say it, and it doesn't make it right or wrong, but it is so hard for me to picture that going deeper into debt somehow was going to alleviate the debt problem. And so I was actually listening to a Krugman podcast today when I kind of think it's really smart, said, this is the moment when I became convinced that I'm a Keynesian, and he posted this 8-minute Krugman debate, and I found Krugman to be shallow and almost incomprehensible. What I found was that he's a devious debater. I found that he's very sort of silver-tongued. I would love to debate Krugman. To me, that would be a particularly exciting thing to do.
Did you hear that Robert Murphy raised, I think, over 50,000, might even be upwards of 100,000 now, for one of Krugman's charities in New York City to feed the hungry, and he won't even debate an Austrian school economist there for the free money, for the money that goes to charity.
Yeah, I have heard that, and here's what I think would happen if they did, and that is Murphy would land enormous numbers of body blows to Krugman. Krugman, with his silver tongue, would say stuff that to me and to you would sound like nonsense, but would be sort of clever debate. I can't stand the debaters who do it to win rather than make a valid point. And Krugman will do it to win. So I don't know how we sort of veered off on Krugman, but he's a particularly foolish character to me. And I contributed 3 pages this year in my year in review to just quotes from him that were just downright stupid. I mean, these were I don't agree with them. They were comically stupid, right?
That was the comedy section of the report. I was laughing at some of the stupid stuff that Krugman continues to say, and he doesn't even check his past performance. He doesn't care. He's like one of those dogs. You leave him for a couple hours to go to work, and then you come back and he acts like you weren't gone at all.
Yeah,
he just has selective memory or for selective amnesia.
And he strikes me as one of these guys who I can picture him as a kid, I think, and he is sort of socially inept, and the beatings he takes from that just make him more socially inept, and so he developed the silver tongue as a defense mechanism. But no, I am truly uninspired by Krugman. There are Keynesians who I think can put up quite a fight, but it's not Krugman in my opinion.
Okay, well, now before we talk about 2014 and what you see for 2014, let's talk about 2013. 2013 we had Cyprus and some other stuff going on. It was basically the year of bad things coming out of news stories in Europe, and the U.S. on a relative basis appeared to look good. Can you go in depth about your analysis of 2013 as opposed to what really happened?
It's interesting. I found 2013 was less interesting than 2012, and I actually had a podcast with Grant Williams, and afterwards we talked about this, and I found 2012 to be comical with things like the BATS collapse and the night trading collapse and MF Global and all these things. I thought 2013 was less interesting in that sense. The civil liberty issue surfaced enormously. I mean, if you read my year in review, which people do, it's something like 89 typewritten pages if you look at it in Word format. But I've had dozens and dozens of emails saying they went all the way through it, and I think by the time you're done with the civil liberties and government corruption section, you would have to conclude the system is fundamentally broken. 2013 economically, I mean, if you actually look at how markets moved and you look at the underlying fundamentals, just this morning I heard Byron Wien say that earnings grew 1%, and we know the market was up from like 27 or 30%, and so there's a complete disconnect there. But these things happen, but they regress to the mean. He pointed out, as a lot of people have, that share buybacks accounted for a huge amount of the share growth. I've certainly seen numbers quoted, $500 billion of share buybacks. These share buybacks are being funded by leverage from the Fed. And so we've got this gigantic sort of Ponzi finance going on where CEOs buy back their shares to pump their share prices, to get their bonuses, to keep their jobs. And if you're paid $40 million a year, every year you keep your job is payday, right? And so it's $40 million per annum. At $40 million a year, I would just have to hold the job for 2 or 3 weeks, and I'd be happy, right? So
it's rent seeking, right? So you only have to meet your bonuses there for 6, 7, 8, maybe 10 quarters in a row, not even like 3 or 4 years, and you're set for life. You have your golden parachute,
and therefore you have no wealth creation. You have guys who are so what Kevin Phillips in his book American Theocracy, which I highly recommend, referred to as financialization of the economy. He went through a bunch of Eurocentric empires, Portugal, Spain, Britain. He said that the death rattle, the final gasping sound that an empire makes is one in which the economy becomes almost exclusively about moving money. And if you look at, say, a bond offering or something, when was the last time you read about a bond offering in which they said we're going to use the revenues from this bond offering to build a production plant? Right? I mean, it no longer happens. It's all about leverage. It's all about arbitrage. It's about I criticize Apple for taking out debt with money on the balance sheet. Some say, well, that's about taxes. I said, but that's stupid, right? I mean, that just means that Apple's doing all sorts of games that have nothing to do with wealth creation. Admittedly, they do create wealth, so maybe that's a bad example. But I don't think there's an economy that's moving money as much as it is, just for the sake of it, as a healthy economy.
Yeah, and you brought up a really good point there about the earnings growth. The earnings growth is not coming from genuine revenue growth. So you're not seeing the corresponding top lines grow where the bottom lines, it's real organic growth. You're seeing the corporate America did do some stuff right. They slashed expenses to the bone after the 2008 crash, right? Because they were in fully survival mode. So, they started outsourcing the stuff they could outsource, switching things to automated systems and computers. We have robot technology in factories and things like that starting to come online now. And, over the long term, that makes things more productive. But, it's not really for the economy to be on a sound footing long term. It has to create the value creation, like you said. It has to create those good long-term jobs. The entrepreneurs have to be willing to take risk capital, and then the small businesses have to be willing to take more risk and start to grow. And I don't think we're seeing that as much. Maybe in a few sectors like shale oil boom here in the U.S. and some technology sectors, but that's not enough jobs for, the 40 million plus people who are on welfare. I believe there's a lot more than that who want a full-time job and can't find one.
Yeah. This wealth distribution issue, which you kind of brushed up against, is going to be an issue going forward probably for a very long time. It is undeniable that the distribution of wealth has broadened way out. It is undeniable that people who are in the bottom end of the scale have stagnated. And where it's going to get very scary is that you're going to get a sort of a growth in state influence, state with a capital S, state influence, in trying to mitigate this distribution, right? This is going to be a political football. And so I think the wealth distribution is an enormous problem, but it's not an enormous problem to be redistributed. It's an enormous problem because it's a symptom of an economy which I think is failing. And that is to say that I think an economy which is healthy, which is producing, material wealth and goods and services, I think will naturally distribute wealth. And I don't quite know what that distribution would look like, but history says, factor of 40 between the sort of the top and the bottom, right? This is a big range. But I think an economy basically just moving money around is an economy that will distribute wealth in this highly distorted way, and that's what we're seeing. And so the wealth distribution problem is a symptom of the flawed economy, not a problem to be solved per se, not in a direct sense. And what's the source of it? Well, I think it's the Federal Reserve, right? I think I think you throw trillions of dollars out on the street and then watch rent seeking, right? As you called it, right? Rent seeking.
Yeah, exactly.
The biggest game in town will be how to make money from that money.
Yeah, exactly. And the total economic pie, I know they make the GDP numbers look large, but they're nominal GDP. They're not counting real inflation rate. They're not really growing the pie in real terms. So in my opinion, the real GDP, the real production or whatever, there's people who don't agree with GDP, but the real productivity of the United States is declining. So you have more and more people. You have the people on Wall Street, the people in D.C., at all levels of government. Because you're seeing property taxes and other taxes start to go up, you're seeing more and more people fight over larger and larger slices of a shrinking pie. And that goes into the wealth distribution that you said, and that's because the underlying economy is essentially, in my opinion, stagflating. So you have, on your consumer staple goods, you talked about last year, you're accelerating depreciation on some of the items. I mean, most of the things 6 to 12 months that people buy now, they end up in a landfill if they're a consumer good. They don't even get recycled. Your food bill's going up. Obamacare, your bills are going up. A lot of other basic necessity prices are going up that the CPI is not covering. And then, the wealth, the taxes are going up. So, the middle class in the United States, which is like the capitalist class, as Doug Casey calls it, they're just having a lot of trouble taking their savings because their discretionary income is declining. So they don't really have as much savings, and then they can't reinvest it.
Yeah, well, I was just, since I wrote this year in review, it's kind of a centerpiece for me, and then it tapers off as the year goes along, and I collect days, and then around Thanksgiving of every year, I start sort of amping up to write this thing. But I've been fielding dozens of emails every day from CEOs of small companies and CEOs and founders of asset management companies, and they all tell this story. Curiously enough, they clearly get it. So it's not just you and me out there going, what the hell is going on? Why is the world so clueless? I think this is one of these, emperor's new clothes thing where if you actually, I can go in the convenience store and talk to the person about macroeconomics and they get it. I mean, they get, at some level they get it. They understand that things aren't working. And the problem is, well, we're going to do damage in trying to make them work by any other mechanism besides getting the economy to be healthy. I wrote about creative destruction. That you sort of brushed against that one too. I threw out an idea this year that I've been thinking about for a long time, but I've never talked about before. Every year I try to put in stuff that's been bugging me, and I have this fear that creative destruction, which is basically out with the old and in with the new. This is capitalism, right? This is capitalism at its finest. So is some product or a factory or whatever becomes obsolete, you bring in a new one, and you just keep revitalizing, and that's normal. And as the buggy whip makers get put out of a job, you just say, I'm sorry, but now you got to make, steering wheels or whatever it is. But I have this concern, and the concern is that we're now going through when the creative destruction process has accelerated so much that we're doing too much destruction. And I started thinking about one day when someone talked about how one of our research labs that had been renovated 7 years ago is now too old, and I go, how can it possibly be? But the interesting thing is, so here's the deal. You go through generations. You get from point A to point Z through steps. If you take too many steps too quickly, those incremental steps become malinvestment, to use a sort of an Austrian term. And someone who doesn't believe it, I mentioned, I said, okay, if you don't think replacing inferior with superior can be too fast, bulldoze your house every 10 years and replace it with a better one. See how you do. The bottom line is you go broke. And therefore, the intermediate houses that you didn't tap into, that you didn't use through a natural sort of life expectancy, represent malinvestment. Too many generations to get to the finished product.
The new technology that you said, replacing things, it would work if the prices on those new items would fall. If there would be an incentive then saying, I would save money, it would cost me less money, it would only cost this amount of money, a lot less than I expected, let's do it. So if people could switch cars, right, and the price of cars, because every single auto manufacturer all over the world, the prices on cars were falling 8% per year or something, right? That would be a completely different. But we don't really have markets like that in many markets. We only really have that in flat screen TVs and some, we have that in laser eye surgery and plastic surgery, and very few markets have full free market forces. And then the other thing, about creative destruction, why I don't think the economy can fully handle it right now, Dave, is that people are so addicted now to government helping them. There's so many people that have gotten student loans, so many people that are getting little subsidies here, subsidies there. Some people are full-blown on the government dole. The government's paying all their bills. So there's just so many people that are reliant on the government literally for their next meal that, that they don't want free market forces because they wouldn't survive them. Or at least that's the perception here. And, I think, unfortunately, this started with the politicians back then because this is what they wanted. We weren't always, the United States wasn't always like this decades ago. When you were younger and starting out, you were talking about price levels and how people were more independent because everything was cheaper and people could afford to do things without debt. And, now people are like, well, I can't afford this and I can't afford that. And, I'll just get something from the government. People just look out for the crutch.
So I wrote a blog years ago which does not exist. And you go, well, how can you write a blog on the internet that does not exist? Well, it turns out I wrote it for Elizabeth Warren's website. And when she ran for the Senate, they scrubbed everything, and I'm talking everything. I've got the text of the blog that I wrote, and I can search fragments of it, and it is not there. That tells you what they do when someone runs for Senate. But the blog I wrote was about the cost, the purchasing power of a dollar in units of something that's familiar. One thing I always try to do is get dollars out of the equation, because it's real easy to trip yourself and say, oh, if we print more dollars, we're richer, right? That's crap. But it's very, very easy. You denominate things in dollars.
It's not crap for Wall Street.
Right,
who makes all their money off asset inflation, yeah.
Right, but it gets crazy. So so what I try to do is denominate things in other things. Maybe I've got a little Adam Smith in me or something. But so I wrote a blog for him, which I mentioned that when I was about 13 years old, I used to carry golf bags for $2.50 an hour. And I also happen to remember when I was at that same age that I bought a pizza for $2. These are just two memories that stuck. And so what I realized is that I was earning 1.25 pizzas per hour. Now, interesting, 13-year-olds, 1.25 pizzas per hour. Pizzas haven't changed, so that's a fixed benchmark. And so I wrote this blog, and I said, and therefore, if you now look at what that represents, 1.25 large pizzas is what, $16, $17, $18? Now, try to find
unless you're buying cheap ones,
it's
more than that. Yeah.
This was a pizzeria large pizza, right? This was not a Domino's piece of garbage, right? So try to find a 13-year-old or a 20-year-old who can earn $17 or $18 an hour.
It's like $20 for one pizza now at a pretty decent pizza place, and it's more than that at a fancier one.
Right. So the bottom line is that I could work for 4 hours carrying golf bags, and that was enough money to buy 5 pizzas. Now think about that. I was 13. Nowadays, as I said in my blog to Elizabeth, I said, the only kids who can make that kind of money now are in drugs and prostitution. Right? and she really adored that blog because she said she was looking for benchmarks like this. And so in any case, I actually only wrote a couple blogs for it. And here's the twisted part, because her blog seems so obscure that I thought, well, that's kind of wasting my breath posting it at her site. And now she's a potential presidential candidate. I'm thinking, you're an arrogant bastard, Dave. You really should, gotten a little humility there and quit worrying about where this thing is being posted. So that's the funny story. So for years I was I like Elizabeth. I'm an Austrian economist. I like Elizabeth Warren. That's like being bisexual or something. I don't know what it is, but it's...
Okay. So basically, then we have reality here, which is what you just described here, and I hear these stories a lot from people who are not my age demographic who remember how things used to be when the dollar was a lot more sound. And what we have right now is management of perception economics, MOPE, as Jim Sinclair calls it, where they're coming out with dozens of new formulas for the CPI, GDP, unemployment. All these things are tweaked and retweaked, and then they're probably going to even change the formulas even faster. Something interesting is I actually just finished this book called In the Plex. It's about Google. And one of the co-founders of Google, Sergey Brin, his father was an economist in the Soviet Union, and he was in charge of retweaking all the models for the Soviet Union for their GDP and their standard of living and their inflation and stuff. And he was on the team, and it was one of his main jobs to come out with propaganda models and formulas saying that the lifestyle was better in the Soviet Union than Americans ever had it. So he would come out with formula propaganda and all this stuff. And when I read that part in the book, actually it was an audiobook on Audible, but when I heard that part in the book, it was unabridged. I was just like, oh my God, that's exactly what's happening now. But no one questions the people in power who are doing all these central planning economics on any of the stuff, and it's the exact same stuff.
I think people do. See, that's the part. It reminds me a little of the start. When the crisis occurred, they say, "Oh, no one saw it coming." The people who say that are just idiots, right? They're just complete idiots because people saw it coming years ago. The first writings on the mortgage market getting frothier in the late '90s. By 2002, it was readily apparent that the mortgage market was starting to get out of control. On my chemistry website, there's a page called Dave Goes Rogue, and there's a link there to an email that I sent to my former roommate named Rick Sherland, who was at Goldman at the time, and he was actually the guy who took Microsoft public, so he's a non-trivial character here. At one point we had this email exchange, and he said, "Well, what's got you so jumpy?" And I wrote this email in 2002. It was about 5 pages. I said, "Here's what's got me jumpy." And I laid out the whole mortgage crisis. I laid out the subprime risk. I laid out how General Electric supposedly took away interest rate risk and then re-engaged it with the derivatives market, and I predicted the banking collapse. And I was just parroting stuff I'd read. I was not creating this from scratch. This was just reading Stephen Roach and Bill Gross and guys like that. But it was clear by '02 that there was a crisis coming. And so then when people say no one saw this coming, there were countless thousands of people who saw the crisis coming. Not in detail, but in spirit. Now, the fact that the economists and the fact that the newscasters didn't see it coming, that's not an excuse. It just means they're idiots, right? But there are thousands of them. Now, here's what was rare. What was rare was the guy like Kyle Bass or like Michael Barry who figured out how to play it. Okay, but guys like Nouriel Roubini, who gets credit, he's a hoser, right? He comes in late. He was years after guys like Stephen Roach were giving us a 10% chance of avoiding Armageddon. Years later, and he's a media hound, and so I mean, Roubini's a joke to me. But there are more smart guys than I saw it, and I stood up in front of my class, a chem class, right? I don't care what I talk about. I'll talk about anything. In March of '07, I said the banking system's gonna collapse. And they looked at me like I come being down from Mars, right? And so what happened? I told them, I said, you could go to the ATM machine and not be able to get money at some point. So 2 years later, I had the same group in honors chemistry. So my first guest lecture in the honors course was the former CEO of Morgan Stanley Bank. And he came in and gave 2 hours of horror stories. This was March of '09.
Oh, that was the bloodbath.
So this was bloodbath. So this guy was the CEO of the Morgan Stanley banking subsidiary, who happens to be a colleague of mine at Cornell at that point. And he told horror stories of crap that had gone down. He had created, this is not exaggeration, 2 million fold levered mortgage packages.
That's insane. That's insane.
It was big. I asked him at the very end. He was wrong on this, but I said, well, 10 years from now, what happened? Is this a distant memory, or is we still a problem? He said, New York would look like Detroit. He was wrong, I think.
Only because of the Fed, right?
Only because of the Fed, and possibly he was right. Right? At some point, this thing could still, there's this book, here's one for your listeners. My favorite book on the Depression is called Banking and the Business Cycle by Phillips McManus and Nelson, written in 1937. And so the Fed hits a problem in 1920-ish. What was the problem? Well, we were in a post-war environment, and every war there's inflation, and every post-war there's a deflation. The Fed said, oh, no, you don't. So the Fed set out to head off the post-war deflation, and they held it up all through the 20s, and then it collapsed in the 30s. And the bottom line is the deflation found its way into the system no matter what the Fed did. And we just got a catastrophic demise instead of a more corrective demise. So the Fed's playing games here. I think the Fed is going to drive us into a bridge abutment doing 120 miles per hour.
Yeah, I think the Fed's trapped, but I don't think 2014 will be the year where we have endgame for the U.S., where the Fed, has to start monetizing all the debt, foreigners start dumping every single amount of treasuries. Yeah, I don't think we're quite ready for that. That could happen maybe 2015, 2016, 2017. You talked about this in your 2014 section. It really looks like Europe and Japan, I think, are in much worse shape in the near term than the U.S., especially because now the U.S., has some cheap oil. The U.S. is, with the shale production, the U.S. is running slightly declining trade deficits. So in the short term, that's helping the U.S. It's making it look, best house in the bad neighborhood, pick your analogy, but, it's bringing the other problems from the other countries to the forefront first.
Yeah, but I get the creeps when people start using the best house in an ugly neighborhood. When you're forced into an asset class like that, it's one your instincts say is bad, but it's least bad. You're already in trouble. I think everything has been pumped to nosebleed levels. So
yeah,
people say, where's inflation? Bonds are 2%. I said, well, how do your treasury's now 3%, but they got really low interest rate. And you say, well, how is that inflation? I go, because the goddamn price of the bond is dictated by the money flow into the bonds. So people think low interest rates tell you have deflation or risk of deflation, when in fact it's this huge levered plays into the bonds that is the inflation. And that's what people don't seem to get. It's mysterious.
They're looking for free market. Exactly, they're looking for free market forces for that high interest rate as a signal, right, as a warning signal. But there's just so much manipulation in the bond market with interest rates. They're not allowing free market forces, and the money is just scrambling into the stock market, into real estate.
But also, if you look at the price of the bonds, there's a thing that's inflated. That is the inflation.
Yeah.
The price of the bonds is the inflation.
Yeah.
And the price of stocks is the inflation. And these guys, oh, God, don't get me going on PE ratios and stuff. So guys go out there and say, oh, yeah, the market's fair value and the PE 50. And that's a lot of hooey. There's so many ways that they jerk that PE around. I think the Case-Shiller is probably the best of them. I can't profess to really understand it, but they try to use real earnings, that is to say earnings that have already been measured. And by the way, there's a guy named David Merkel who I've been watching for a number of years. He writes a left blog, and he says when you get into this messy situation, you watch the change in book value over time. Now, why is that important? Well, because if a company's earning, say, 10% return on their investment, but it's a crock, then at the end of the year, if it was a real 10%, the company would have a 10% growth in its book value or 5% dividends plus 5% growth. But if it's fictional, then you won't see the book value change. So if you watch long-term trends in book value over time, you'll find out how much the company's really earned as opposed to...
What I was also taught, and I've read a lot of books on investing, is that it's not real earnings growth unless there's revenue to back it up. So if you're sacrificing all of your margins to grow, so you are growing revenue, but you're sacrificing all your margins, that's bad. The market won't really like that much. But if you're not growing your revenue at all and your margins are at all-time highs, because I think net profit margins are, at 15%, and they've slashed basically everything.
I don't know what the number is, but they're at all-time highs. That is correct.
Yeah. So they've slashed all the expenses basically they can to the bone without, for factory workers, without completely replacing everyone with robots yet. But it just seems like the asset price.
That would be good news if the profit margins were at all-time highs because of robots. But it's Merck. I mentioned Merck. Merck started to have a pipeline problem. So what they do, they took money instead of developing new drugs, they did share buybacks, and so if you're this is the silly part. You turn on CNBC and they'll talk about profit margins being at all-time highs. Like, that's good news. Profit margins regress to the mean. They're the most regressible things out there.
I see that as a warning sign.
It's like saying,
I see that as a top. Mm-hmm.
It's like saying we're in this meta-stable situation and it's got to regress to the mean, and somehow that's good news. That's not.
Unless, Dave, and I've told this to my listeners generally, I don't know if you've listened to my work, but if we're in the beginning stages of the crack-a-boom, the von Mises-style crack-a-boom, where, the currencies really are completely, totally being destroyed, and this is accelerating, you are going to see ridiculous valuations on real estate, on stocks, on bonds, you're going to see the asset prices because just go sky high nuts, like 40 times earnings, or a late 90s type of thing or worse. And you're going to start to see, and I think you're already seeing this too, you're seeing flight capital leave Europe and Japan and China. You're seeing enormous amounts of money, billions of dollars, that are leaving those markets. It's going into rare arts and wine and collectibles, antiques, diamonds, those types of things. But it's also going into U.S. real estate. It's going into some short-term duration bonds in the U.S., and it's going into those large-cap dividend stocks. So it's not, there's arguments to be made that, this is the market top. But if we're in the crack of boom here, the currencies are going to, you're going to see the yen just get absolutely wrecked against the dollar, and you're going to see U.S. markets go up a lot because of it, because the Japanese person is going to take their yen, they're going to liquidate their JGB holding, they're going to buy U.S. stocks or whatever they can get for it, right, outside of Japan or gold or whatever. And then, Japan's going to have to monetize, their central bank's going to have to buy even more debt on the open market, and then that's endgame for their currency. So I think that's the point we're reaching. I don't know how long this is going to take, though, and how long they're going to be able to keep this going for.
Yeah, I have this feeling, I have this hunch that there's more than that model, and that is to say, I have this hunch that the market will find some way to veer off in a way that you didn't expect. It could be like another credit crunch, right? So we in principle had a crack-up boom starting in 2007, and then all of a sudden we had this complete collapse. And so, the market's going to do everything it can to make as many people as possible look really stupid, and that might include you and me. But I do think there's a day of reckoning. I spent a lot of time in my annual year review talking about debt. The problem with debt and lack of savings, right? The two are go hand in hand. There's some staggering stats. The average boomer age 55 has saved $70,000. So you say, oh God, what's going to happen? And the answer is he's going to starve. Right, and this is this
$10 job at Home Depot or McDonald's.
But that won't pay for it. He's still going to starve.
Yeah.
That's what the Home Depot guys are telling us. You can't eat off that, right? McDonald's workers can't pay for McDonald's, and then you say, well, what are we going to do about it? It's like, well, this has got the sort of the sound of the person dying of pancreatic cancer, saying, well, what do we do? And the answer is you die. And so this unfortunately is potentially the path going forward. I don't think it's an event. I think it'll be a process. So last year I concocted this semi-hypothetical but very real character I called Mr. 5% guy. And I define Mr. 5% guy as a guy who's top 5% earnings and top 5% net worth. And so this is a hypothetical guy, but there's people who fit this description. They're at the 5% mark. And Mr. 5% guy is also probably a boomer since he's up at the 5%. He's gotten there. It's just the American dream. He made it. So this is the boomer. Now, what's he making? He's making $154,000 a year. And what's his net worth? Well, it's around $1 million. Although Stephen Roach said only about 500 of it's financial assets. But let's call it $1 million. You say, okay, so Mr. 5% guy retires. What can he expect? Well, using conventional portfolio theory, not Jason Dave wacko theory, conventional portfolio theory. This guy can take about $45,000 a year out of his retirement account and not risk too badly running out of money. He's still risking running out of money. There are people who say you got to assume 3%, not 4%. That leads to a much more dire $30,000. So here's the guy you say, well, there's people who live on $30,000. Yes, but not people who earned $154,000. So this guy's going to be going to Big Lots. He's going to be eating ramen soup, and he's not going on any vacations. And he's the top 5%. Wrapping my brain around that is so mind-boggling to me that a guy at the 5 percentile mark could be in so much trouble.
Well, I think, Dave, that's a great point. the story that you just told, and that's why the Keynesians, their manipulation of everything starting with interest rates and prices and stuff, that's why prices had to fall, because the reality is the returns that you just said, right? That's the reality of the situation that we're in. But the Keynesians have to have higher prices, right? Because that's how Keynesian economics works, because they think higher prices are a higher feedback loop. It leads to lower unemployment and higher paying jobs. But that's not how reality works, because reality is when you only have that much money for retirement, the economy cannot withstand higher prices. So people could survive on that salary if prices fell dramatically, say 50% across the board. But do you really? I don't think the Keynesians would allow a situation like that. I think they'll devalue against gold. I think they'll pull an FDR type 33. What was it? 33, right?
33, yeah.
Yeah, 1933 type situation. Their nuclear option that they have is to, if nothing else works, to fight deflation in the key aspects that they want. They will confiscate the currency they have now and issue new currency and devalue it against gold or something like that.
Well,
so,
but I'm not sure. I think if they actually do something against gold explicitly, implicitly it happens all the time, right? It's the dollar's devalued against gold over the last 15 years by factor 5. But I don't think the gold as a benchmark steps into the equation until after. I don't think it steps in until we've kind of hit an almost road warrior level. The gold standard will reappear when all the other options have failed.
I don't think the foreigners want the gold standard either. I just think they want like gold as an option to settle because they're just getting really fed up with the.
Therefore, that becomes an implicit gold standard, and it basically says, look, you got a choice of gold or Beanie Babies. They're going to say, well, we're going to use gold. And it doesn't matter if some sovereign state says no, the currency of the realm is Beanie Babies. No one's going to use it, right? And so that's where the gold standard emerges as a grassroots movement. And I think the Asians are going to force our hand on that. I think the migration from west to east this year, which was absolutely enormous, volumes of tons, hundreds of tons of gold moving. They say China, I think, imported 2,200 tons of gold this year, right? So there's something happening in the global currency regime right now, right in front of our eyes. People don't want to believe it. The guys who never own gold are thrilled that the price dropped, but the guys who do own gold have noticed that there's these geopolitical seismic events occurring in the gold market. They really look much more important than the price itself.
Yeah, and if you own physical gold outside the system, the price really doesn't matter a whole bunch. It's more that it's insurance, So you're not playing the paper game with prices and stuff like that if you buy physical metal. I think that's something that a lot of gold bugs have forgotten in the last couple of years. As they watch, the paper price come down, you just start seeing people chase Bitcoin and stuff like that, unfortunately.
Yeah, the problem is, though, some of these guys say, I don't care what the price of gold is. They're being a little disingenuous because the fact of the matter is if I have some number of ounces of gold and then I want to use that preserved wealth to buy a car, I got to convert it to dollars. And so if all of a sudden the price of gold buys me half the number of dollars and the price of cars is not doubled or tripled or quadrupled yet, then parking in that gold costs me money, right? So I don't think it's fully. These guys who say, I don't worry about the price of gold because gold is the only hard money. That's a bit of it. That's disingenuous in my opinion because you still got to be able to convert to dollars to buy the goods and services. Right now.
Yeah, but I mean over the long term, though, keeping a large chunk of one's savings, outside of currencies, so not holding, your money in the short-term notes, the short-term bonds, or money market funds or things like that, where there's no return. Gold's a good alternative to that because you're not getting paid a rate to hold it, and you're not going to get inflated away there. Like I said, it wouldn't be all your money because obviously you need to keep some working capital to pay bills and things like that, but I'm talking like a substantial chunk of your principal savings, like if you believe in our macroeconomic analysis. But let's talk about 2014 here before I let you go. do you think then that I've heard Martin Armstrong talking about a 10% wealth tax in Europe. The IMF is writing white papers on this. Larry Summers, I believe, is talking about this. The Europe did not recapitalize their banks. Do you see that happening? Do you see other crazy things happening in 2014 where people just lose more of their liberties and more of their money to taxes and other confiscatory schemes?
I hesitate to put a date on it. I don't know if it was 2014 or 15 or 16 or whatever, but going forward, if in the year in review, I think the most out of 89 pages that I wrote, I think the most important chapter in the whole thing is the chapter on Cyprus, where they confiscated wealth. And it's not just because Cyprus went belly up and is now in this grinding poverty in a banking system which is completely collapsed, but the fact that they confiscated it, and then, as you sort of alluded to, people of enormous prominence within the financial system started spouting off about how Cyprus is a good model. And as a consequence of those statements, I say, okay, Cyprus wasn't a collapse. Cyprus was a beta test. Cyprus was a mechanism to see if you can systematically sort of nuke the entire wealth of a country and get away with it in a sort of an MF global heist sort of way. And they did. And so would I ever put money in a bank account in Club Med, right, in Portugal and Spain and Italy and all of a sudden? No. I think there's got to be bank runs going on in Europe right now because the smart money's got to be saying, get me out of here. They're going to do it. And, the rumors that they were looking at Luxembourg to take them down. So I don't quite know what the motivation of Cyprus is, but I do know that what they did is they went in and they just took the money. They didn't collapse. They took the money. And that is so spooky. I think I write about how I think they could end up doing that in retirement accounts in the United States. They're going to talk about capping it. They're going to talk about...
Yeah, Jim Rogers thinks they will.
It's a total confiscation. They're talking about capping the amount you can have. Well, what happens if it grows? Well, are they going to therefore take it? They talk about capping the amount you can take out. Well, if you have more than that, does that mean therefore that you'll never get it out? They talked, the most spooky thing of all to me at some level was Obama called it a retirement annuity, which tells me that they're looking at my retirement account as a situation which I get to spend it at a rate that they set, but when I die, they keep it. And that is not what I signed up for.
Yeah, that's a very scary thought. And, I think a theme here, and it started this way really since the 2008 collapse. That's really what got me interested in investing and learning in the markets, is that the rules keep changing, Dave. The rules, if the rules were set in stone or they're not, they were very simple and easy to understand, it would be a lot easier to adapt to the system and stuff like that. But they're changing the rules behind closed doors. They're changing the rules, it seems like, every couple months now. They're looking at new ways, new schemes to figure out ways to get more tax revenue, whether it's from, raising property taxes or a wealth tax, potential wealth tax, because that happened. There was confiscation in Poland, and then even more of that's being discussed in Europe. They're just coming up with new ways to change the rules and take more and more from us and make our lives more difficult to just keep our heads above water. And that's what really upsets me and scares me the most going forward.
So here's what would happen. So someone who doesn't yet see it this way is likely to listen to those things you just said, and they'll call you a conspiracy theorist. We previously talked about how economics had obsessed over mathematics. And I submitted that you've got to understand history. You've got to understand what happened in the past to understand what happens going forward from this point. And so someone who would say you just spouted off a bunch of conspiracy theory, first of all, I find it a pejorative term that makes me want to smack the person in the face. Because if 2013 taught us anything, is that conspiracies are everywhere. You throw trillions of dollars out into the system. If you don't think men and women are conspiring to manipulate and commandeer that money, then you're just a moron, right? I'm not even going to talk to you. You pull your head out of your butt on that one. But the problem is, if you look at history, you'll find that what you just described has happened over and over and over again. It is the norm. Sovereigns confiscate wealth, period. Always have, always will, right? Kings take it and they burn it in wars, and they've been doing this since the dawn of time. The state confiscates wealth. And there's periods where they confiscate it in benign ways that, maybe they build roads and whatever and have a standing army for self-defense. But then there's times where they get ham-fisted. And if you somehow think that history stopped taking shape, some Francis Fukuyama malarkey, and you think now modern states would never do that, then you're just a fool, right? I don't have time for you. And you can worry about whether it will happen this time. I'm okay with that. But if you want to dismiss it as just foolish, ponderings of a conspiracy theorist, we have nothing to discuss. That's my response to such a person, and I'll call him an idiot, right? I'm really getting weary of the conspiracy theorist label because it's designed to shut down a discussion of the problem that's lurking. And if they don't like what they're hearing, they'll say, "Oh, you're a conspiracy theorist." I go, "No, I'm just worried about conspiracies. You're an idiot," and that's a bigger problem.
Well, what I hear from Wall Street, Dave, I don't hear necessarily the conspiracy theorist label when I talk to my Wall Street buddies about this, is I hear this is not investable. I may agree with you, but I have career risk and performance risk. I'm managing this amount of money, and all the stuff you said, it might happen next year, the year after, 5 years, 7 years from now. And if I don't meet my benchmark targets for next week, next month, next quarter, next year, I'm fired and out of a job, and I don't know where I'll find more work, blah, 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 blah. So the majority of people, who are controlling the money, the people on Wall Street, they're too short-term oriented and myopic to really care. Plus, a lot of them are really rent-seeking and not focused on long-term value creation. And the people in D.C., if you presented this argument and in front of a rational congressperson, if you could get time with them now because they're so busy with lobbyists and stuff, they might say, this doesn't concern me because I only care if I can get elected next term or whatever. So we're at the stage here where the people who are in power economically and politically, they don't care what happens 4 or 5 years from now for the most, or at least most of them don't. They only care about the next year or two, and that's probably even overestimating the amount of time they care about.
And this is a system which is rotting from the core, based on that description. I think I used it in the review. I certainly have tweeted it, where I said that when an asset class reaches a stage where the money managers have to buy it or risk their career, it is probably time to sell that asset class, because it's been pumped up, right? So if you have to buy Netflix, because if you don't, your clients will say, you had no Netflix, it went up 350% this year, and you're
Bitcoin, yeah.
You're such an idiot that you didn't own it, right? But when career risk is forcing you into an asset class, it is time to sell that asset class.
And that's a very good point, Dave. Now, last question before I let you go. You have firsthand experience of what's going on in college at the educational level. Now, you happen to be at one of the finest institutions in the United States of America. But what's your opinion on the loan bubble? Because we have a lot of young listeners here who want to learn investing in finance, who listen to Wall Street for Main Street podcast. They're just graduating college or graduate school, and they're out in the workforce looking for a job, and they're buried in student loan debt, but they want to start investing. What are some tips then that people can figure out then how to get themselves out of the hole that maybe they've dug themselves into?
So last year I wrote about how the student debt bubble was being called a bubble, and I sort of contested that argument because I said I couldn't see a popping mechanism because there's all these legal protections to prevent the debt from going away, which, by the way, are egregious. I understand why they got put in place, but they're egregious because one of the great things about the U.S. system is you get to sort of zero out the Etch-a-Sketch and start with a barrel, but start fresh. And so when you lock people into debt that is absolutely inescapable, you've put in constraints on a system which are oppressive, right? And so I don't know how to get around this. I do have some ideas, but there's people in it, and I say, I don't know how this debt bubble pops. Well, it turns out, as I said, this year, apparently they didn't read my year review because it's popping. And the fact is that students are walking from their debt, and they're probably not opening up the statements from the bank saying you now owe X plus another 5%, now you've got penalties, and they're just saying, screw you. It doesn't matter what you say to me. I can't pay. And we're destroying a generation psychologically here. I don't see a way around it. What I can do is provide insight to people, and I don't know what to tell them, their host. Unless we have debt jubilees. I'm not a big fan of them, but if we could. But young people, kids coming out of high school, right? I'm now at the age where all my friends are contacting me. One of my most favorite bloggers named Doug Nolan's going to bring his son and visit me. He's a big gun at Federated Investors. And everyone now has got a kid going to college. My advice to them is don't blow the money. If you go to Cornell and you study the right stuff and you work hard, it will pay you handsomely. But if you come and you spend $50,000 a year to do keg stands to get a 2.0 GPA, you're wasting your money. And if you come here and you major in something for which there's no jobs, you're wasting your money. So I argue that when you go to a college, you got to make sure you know why you're paying the big bucks, and if not, go to a place that's cheaper. And you better make sure you know why you're studying and what this career is going to get for you and how you're going to extinguish the debt. And you better know that you're competing in a global marketplace that says, look, if you graduate from college with no skills, no marketable entry-level skills, you're going to hurt. And you can't just go to law school anymore and sort of do a do-over because no one wants any lawyers anymore either. So the bottom line, I see kids at Cornell who are going to rock. I see kids who are going to be so fantastically successful. But I also see kids who shouldn't be spending their money. Both my kids took time off to go work. One went to Aspen to work in a hotel for a year, and it had some perks, as you can imagine. But these, and if you're a parent and you're so afraid your kid won't graduate, I get that. But if your kid's squandering it, get the kid to take time off, get him to go earn some money, get him to go work out there, and then hold your powder dry and use it wisely. Wait till the kid's ready. And I see some of the smartest kids in the country show up who are not ready. Those parents, instead of letting the kids fry their way through college, should somehow talk them into, going and seeing the world. And parents usually are the obstruction in this process, not the kids. The parents are often, oh, no, you can't drop out. And when my son took a year off, some person close to me said, oh, he's never coming back. And I said, I'll kill him if he doesn't come back. So I assure you he's coming back. But he needed to get away. And so there's all sort of, someone wants to call me and ask me questions, that's fine. I'm an open book. Someone wants advice, send me an email, that's fine. Because you can spend $250,000 sending a kid to Cornell. And Cornell is ranked in the top 10 in more departments than any school in the country. There's a stat for you that makes me fiercely proud. But you can send a kid to Cornell and waste your money. So make it count. That's my advice. Make it count. Think about what you're studying. Think about why you're studying. Don't come until you're ready. If you come and you're not ready, get the hell away. Come back when you are ready and study and work because you're competing in a global marketplace.
That's some very good advice, Dave. And in terms of other educational universities, I mean, there's just so many of them now, and tuition prices have risen so much that, not every university is on the level of Cornell. And there's a lot of universities where there's really bad teaching. I actually dropped out of an MBA program at Virginia Tech Satellite Campus that's not too far away from where I live right now outside the D.C. metro area, and it was because the professors were just reading right out of the textbook. They didn't even know what they were teaching.
But more importantly is even your peers. So if you're surrounded, I think peer, just like, adolescence, peer learning is really important. So what you find at a place like Cornell, these kids are smart and they compete and they're aware, and so they elevate each other. They elevate each other's game. Now, Obama and these guys, the politicians talk about, say we need more college-educated people. That, in my opinion, is wrong. It's dead wrong. We need more skilled people. And if college is a way to get those skills, fine. But there's other ways to get them. and there's too many people who remember the 90s where, Henry Blodgett graduates with an English major and becomes a gazillionaire before he becomes an inmate briefly, but he becomes
Henry
a
Blodgett?
gazillionaire.
Yeah, I'm not a fan of that guy.
I think he's rebranded himself pretty well, actually, though, in general. But the fact of the matter is that you can't just tool your way through school and get a sheepskin and come out and get a job. And that delusion has got to burst. So if you're a parent,
and even if you do actually, manage to beat those 50 or 100 or 500 people for that full-time job, you can work your ass off 70, 80 hours a week. You do one little thing wrong. Even if you don't do one little thing wrong, they could still fire you anyway because they're looking to cut costs, because that's just the environment we're in now. They could outsource your job to another country or replace you with a software program or computer program or something like that. So
yeah, but a talented person with skills will land on their feet, in my opinion.
Oh, I'm just saying, like, the conventional wisdom, though, the old school conventional wisdom is dead, though, about, you go to school, you work your butt off, whatever the student loans are, no big deal. You'll find a long-term, a full-time job, and then get long-term employment from it, and you can work most of your adult life in that career. That dream is essentially dead.
It is for now. It is for now. Won't be forever. We'll cycle just like everything else. But college, you have to go at it like a consumer, viciously analytical.
Well, I think that is great advice for our young listeners out there, or for our parents who are listening who are considering making the investment in their kids' education in the college level. So I just want to thank you, Dave, for your time. And please tell our listeners the websites where your 2013 review and 2014 preview are located, so they can check that out. I absolutely highly recommend our listeners read those. It is very long. It will take you some time. It took me about a week off and on to get through.
No one will touch it. It's 89 typewritten pages. People describe it as a 4 or 5 hour read. You might have died. You might have spent some serious time pondering. Based on a few email exchanges we had, I suspect that to be true.
I read annual reports looking for investing opportunities, and I listen to 2, 3, 5, 10, 20 hour audiobooks. So I'm used to putting in hard work to get the little couple nuggets of great info, and I think your analysis there definitely had that in there.
So if you want to find it, it is primarily posted. The first post is peakprosperity.com. That's a Chris Martinson website. It gets secondarily posted. This year was about a day later at Zero Hedge, which I'm a great fan of. I think Zero Hedge is a great site, despite the fact it's a bunch of wingnuts. My email, well, you guys can find me. I'm the department chair, professor of chemistry at Cornell. If you're not smart enough to find my contact from that, you probably shouldn't be investing. But interestingly, on my departmental website, I've got this section called Dave Goes Rogue, where I basically slapped up a bunch of links. It's not up to date, so it doesn't have this year's Peak Prosperity. If you search my name, David Collum, on YouTube, you'll find a couple of interviews. One this year with Aaron Aid on Boom and Bust on Russia Today. Last year I did one with Lauren Lister on Russia Today and Capital Accounts, and I did some podcasts, not only with you, but with Chris Martinson and with Jim Kunstler, who's an energy sort of futurist. I did some BTFD TV. One of the episodes was controversial and untaped, and probably saved some bacon. What else can I tell you? So I'm on Twitter at David B. Collum, one word, at David B. Collum. I tend to tweet stuff that's somewhere between total nonsense and little nuggets. Of course, what else is to tweet? But my tweets are not particularly deep looking, in my opinion. I'm just having fun. I think of something funny and I tweet it. And, big one today was mentioning it was 371 below zero today. I mean, this sort of level of nonsense. But I have fun on Twitter, and I'm a huge Twitter fan.
Yes,
the people I follow are serious players. so although I'm out there just putting out white noise, they're providing great content to me. So like you.
Well, thank you. Well, thanks again for your time, Dave, and hopefully we'll have you on before 2015 comes along.
Anytime
for your
you
review.
want. Anytime. This was fun.
Okay, thank you.